Hi, my name is Dan Kezner, and I'm here with you from Kezner Consulting Group. Today, I wanted to talk about creating a restaurant Proforma. This is a great place to start when thinking about opening a new restaurant. First of all, it helps you create the financial awareness that is needed if you need to put together a business plan down the road. It also helps restaurateurs or future restaurateurs understand the basics about the restaurant business and its financials. What is a restaurant Proforma? A restaurant Proforma is a tool that predicts financial projections and calculates profits and expenses for your restaurant. So basically, what we're going to be doing is predicting all the financial aspects of our restaurant business, from our sales or revenue to our cost of goods, to our labor, and then all of our other operating expenses. So let's dive in. In the Proforma tool that we've built at Kezner Consulting, we utilize Excel. And within this Excel worksheet, we have several different tabs. And I want to walk you through those tabs for just a moment. So the first tab we have is our assumptions. Assumptions is all of the things that we are going to assume about our business. And we'll dive into this sheet in just a moment. We then have a single year Proforma. It shows our revenue, our cost of goods, our gross profit. And then as we scroll down, it shows our labor, our salaried labor, any supervisor labor, our front of the house hourly, and then our kitchen or back of the house hourly. And then we get a prime cost. And then below that, we have all of our operating expenses, which we will discuss later in this video. The next tab we have is the 10-year projection. And the 10-year projection takes our single year projection with some extra inputs on our assumptions page to show our predicted sales growth, predicted cost of goods growth, predicted labor growth, and then also how our rent may increase from year over year. Then we have two different labor models. We have our front of the house labor model or our service labor model. In this tool, what we can do is we can actually program in pay rates and then specify the different shifts that we need for each day and then put in those scheduled times. And the tool will then calculate how many hours each person has worked and then also what that cost is associated with that. And then that gives us a pretty accurate labor schedule with very accurate labor costing predictions. We also have that for our kitchen labor. So let's back up and go back to our assumptions page. And within our assumptions page, the first thing that we need to assume or predict is our sales. And there's a couple ways to go about predicting sales depending on the type of restaurant you have. The example you see here is for a full service restaurant that has tables and chairs, and we are going to be predicting how many times we're going to be turning each of those seats throughout the week and day part. So as you can see here, we have our day sales estimates, we have a night sales estimates, and for this particular use case, maybe we have a late night sales estimate. And this is just a nice way to break out different day parts that you may have. So the first thing we got to kind of understand is how many seats in a restaurant are we going to have? This particular restaurant may be close to 5,000 square feet and thus have about 220 seats. Obviously, every restaurant will be different. After we've predicted how many seats we're going to have, we then think about how many times are we going to turn those seats in any given day and day part. So what I've listed here is, let's say we have 220 seats, and on Monday we have 0.4 turns, which would be 40% of the 220 seats I think we're going to utilize during our day sales or lunch, which would be for this restaurant, for Mondays. Tuesdays would be about the same. Wednesdays would be about 50%, so about 110 guests or covers is what we call it in the restaurant business. Thursdays a little bit more, Fridays a little bit more. And so then what we do is we have a total cover count per week. So for lunches, we're going to do about 1,177 covers or guests. And again, this is just for our lunch. And then what we do is we have to figure out how much is each one of those people on average going to spend. And that all depends on the type of menu you're thinking about and the price point that you're thinking about. In this particular restaurant, we are going to assume that each guest was going to spend about $19 per visit. So what we then do is we multiply that $19 for how many guests we are going to have, and that gives us a weekly sales of about $22,363. We then can see on average what we're going to sell per day, again, just for this day part. And then per month, this is just an average estimate based on 30 days. And then we have our gross sales for this day part for the whole year. And then we get our daily net sales. So let's run through that one more time, a little quicker for our nighttime estimate. So again, we have our 220 seats. Night's going to be a little bit busier than day. So we're assuming that on Mondays, we're going to do 50% of our 220 guests, which would be 110 guests. Then Tuesdays we do 75%. Wednesdays, again, 75%. Thursdays, we think we're going to fill up the restaurant one time. Fridays, we think we're going to fill up the restaurant 1.5 times. Saturdays, 1.5 times. Sundays, 1.25 times. So we'd be multiplying this 220 by 1.25. Now dinner, slightly different menu, higher beverage consumption. So we've increased our guest average to $36 per person. Now, in a seated situation, we want to also account for takeout. So what we can do here is we can put in this additional daily income. So this is our additional sales per day, which could be takeout or wine to go or cocktail kits to go, whatever your business is doing. So let's plug in about $100 a day for additional income at dinner, maybe $75 additional income at lunch. So as we move through this now, we now have a night sales of 2.9 million, and this brings us to a total of 4.9 million, and that's including this late night business as well. So if we want to take a step back and do a check to see if our numbers seem reasonable and accurate, because that's what we're trying to do here with the Proforma, is we're trying to predict accurately and reasonably what our potential sales could be. We're going to slide over and we're going to kind of break out our sales based on days and our day parts. So on an average Monday, based off of our assumptions, we do about $1,600 in sales. For dinner, we do almost $4,000 in sales. And late night, we do about $550. And that would come out to about $6,182 in sales. On a busy Saturday, we would end up doing about $23,000 in sales. In my mind, a restaurant of this size, it's totally feasible for this restaurant to do about $23,000. Now, again, this is a large restaurant, and your restaurant's numbers may be dramatically different, and that's okay. That just is what your business is going to produce. So now that we've got our sales in, the next step is to weight our sales by month. So we have our total sales for the year, again, at 4.92 million. And what we want to do is we want to predict which months are going to be busier than others. So you can see in this model, we have January at about 8% of our 100% total sales for the year, right? As we work through the year, it's a little bit slower. April being our slowest month at 6.29. and then May it gets a little busier, and then summer comes around, and this particular restaurant's going to do better in the summer, so we've allocated a greater amount of sales for those months. And then it slows down in the fall a little bit, and then come December with all the holiday parties and corporate dinners that they're going to be doing, we then put the greatest amount of weight of our sales in December. And then as we scroll down, the next kind of questions to answer are our salaried labor predictions. And when thinking about our salaried labor, again, every restaurant's going to be different demands. Some restaurants, the owners may choose to have no salaried labor themselves and choose to manage the restaurant themselves. Other larger restaurants may have very large management teams. In this particular case, this is a larger management team. So what we've shown here is that in this particular market, a GM, we're going to need to pay about $95,000 a year. An AGM will pay about $68,000 a year. We're going to have 2 front of the house managers in addition to the GM and the AGM, and we're going to pay them about $55,000 a year. So that total is $110,000 because there's 2 of them. And then we're going to have a kitchen manager or chef, and we're going to pay them $80,000 a year, and the assistant kitchen manager $70,000 a year. So that ends up totaling up to about $423,000 a year in salaried labor. And then our monthly labor is broken out here, and so our total monthly labor would be about $35,250. This will end up being put on that 2025 Proforma. The next piece down here is our labor projections, and what this is our hourly labor projections. We'll start with the front of the house, and we've predicted about 10.99%. And in the kitchen or back of the house, we've predicted 11.45%. And these numbers are coming from these front of the house labor model and kitchen labor models that we've built. We can also just directly plug in estimates until we have time to do these front of the house labor models. So we're going to scroll back up to the top, and we're going to slide over to kind of the phase 2 of this. This is a really important category. So this box here shows us our category net sales estimate. What that means is how much of that 4.9 million or total sales that we are going to have for the year is going to be allocated towards food, wine, beer, spirits and NA beverage, and merchandise. Your particular restaurant may have different categories. You may not sell alcohol, and you may be a coffee shop, in which case we would have a separate category potentially for coffee. I like to, in a traditional restaurant bar situation, bring together spirits and NA beverage because down the road, when it's time to create a budget, it's very difficult sometimes to separate out NA beverages that are associated with our mixed drinks versus NA beverages that are sold directly as NA beverages. And when I say NA beverages, I mean non-alcoholic beverages. So as you can see here, we've shown that this particular restaurant, or we've predicted that this particular restaurant is going to be having about 51% of their sales coming from food, 5% wine, not a lot of wine sales, 17% of their sales will come from beer, and 27% of their sales will come from spirits and NA Bev, as this is a very bar-forward concept. The next piece is our predicted cost of goods targets. So every one of these sales categories is going to have costs associated with them. When we sell $2.5 million worth of food, we are going to have to incur cost to buy the product that we are going to sell. And in this particular restaurant, our target cost of goods is going to be about 29%. Your cost of goods targets may vary based on several things. One reason they would vary is if you're in an area of the country that has a very high minimum wage labor without a tip credit, which would lower the labor for tipped employees, you may have to have a lower cost of goods target in order to keep your restaurant profitable. And in those situations, you may want a cost of goods target anywhere from 25 to 27%. If you are a steakhouse, you may want to have closer to a 40 or 50% cost of goods. And that's because in a steakhouse, you might be charging $60, $70, $80 for a particular entree. And in the end, we are always depositing cash, not percentages. And we'll want to make sure that the revenue coming in is adequate. But at that point, our cost of goods can be a little bit higher. For our wine, we have about a 30% cost of goods, which I think is a good benchmark. We're not selling merchandise here, so we're not going to have a cost of goods prediction for that. Our beer cost of goods is hovering around 25%, and our spirits and NA Bev is about 23%. And again, depending on your business, your product mix, the type of beverages you're selling, your menu pricing, all of these things weigh into where your cost target should be. All right. And then as we move down, the next thing we want to do is predict how our sales, our expenses, our labor, and our rent are going to increase over time. Because not only are we producing a 1-year Proforma, but we're also going to be producing a 10-year Proforma. In this particular situation, I have, obviously in year 1, the sales will be static, or our sales growth will be 0. In year 2, we're going to have about an 8% sales increase because people are becoming more aware of our business and sales will go up at a pretty good clip. Year 3, we're at a 6% sales growth. Year 4 and year 5, we're at a 5% sales growth. And that would continue on at 5% over the following 5 years. Our expenses are also going to go up. We've predicted, based on our experience, that our expenses go up about 3% per year. Our labor is also going to go up, so we've predicted about a 4% labor increase per year. And then rent, in this particular situation, the rent is static, but in many other situations, your rent would also go up several percent per year, maybe 3 to 6%. Before we go any further, I want to move into our actual 2025 Proforma and take a look at what that looks like based on all the assumptions we've put in. So based on the assumptions we've put in, we can now see that our revenue, our total revenue for the month of January was $393,774. And based off of the percentages of those sales categories, we know that 5% of our sales is coming from wine, which would be about $19,000. Our prepared food would be about $200,000. Our beer would be about $66,000, and our NA Bev sales would be about $106,000. Again, all of this is coming from those predictions that we made in our assumptions page. Next, we're going to move down to our cost of goods. As you can see, our cost of goods targets that we put in the assumptions page are listed here at 30% for wine, 29% for food, 25% for beer, and 23% for spirits and NA beverage. And here is the associated expenses that are calculated based off of that. And the calculation is based off of the $19,000 we did in sales times the 30% that we've projected for our cost of goods ends up being $5,907. So let me say that again. So our $200,000 worth of food times our 29% cost of goods target is showing us that we are going to be spending in that month $58,000 on food. And then we have our total cost of goods coming in at around 26.75%, which anything below 27%, I believe, is a healthy total cost of goods. And then that generates what we call a gross profit. And a gross profit is basically just the items you sold and the profits from those. It doesn't account for labor or any operating expenses for the restaurant. And in this particular situation, after we've bought all of our items and we've sold them, we have $288,000 left over, or 73.25%. So scrolling down to our labor section, our labor section is broken out into 4 pieces. We have our salaried labor, which came from the assumptions page. We have our front of the house hourly labor, which has come from our front of the house labor model, and our kitchen labor model informs our back of the house hourly. And this is our total labor expense. You'll notice that I don't factor in labor taxes when doing a Proforma in the labor section. And the reason why I do that is because I have certain benchmarks that I go off of that are based off of pre-labor tax numbers. I add the labor taxes down here under operating expenses, but if you would like to see your labor combined with your labor taxes, we can always move this number up to your labor section. So we then have what we call a prime cost and prime profit. Prime cost is your gross profit minus your labor. Sometimes prime cost can include other operating expenses such as supplies, but for the basics of prime cost and prime profit is cost of goods and labor. And as we move down, now we have all of our other operating expenses. And these can vary from state to state, city to city, concept to concept. And, the first one is our labor taxes, as we discussed. This particular Proforma is for a restaurant based in Washington State. And in Washington State, we're averaging about 16.8% labor taxes based off of our total labor expense. So that's why I've plugged in this 16.8%. Health insurance can be looked at in many different ways. In this particular situation, let me come back to the assumptions page. We have a health insurance calculator. Here, I've put in the average plan price of $600. They're going to have 6 people that are getting a plan that it costs $600 a month, and the business is paying 100% of that fee. We can have other classes of employees as well. And to be honest, this restaurant will have those. We just haven't gotten a good quote on our insurance prices yet. Continuing to move down, we have any bonuses that would be paid out, any kind of sales commissions, which is not applicable in this particular concept. We have employee relations. This could be like employee parties or fun events, any travel meals or expenses related to the owners, licenses and fees. We have our point of sale system. We have insurance. We also have our rent here. And again, rent can be calculated on many different things, but this is the particular rent. You'll see it says rent plus triple net. Triple net is the additional fees that you pay for rent that are associated with trash, facility upkeep, maintenance to the building, elevator maintenance. It all depends on the building and could be an array of different things. Utilities is the next line item. We have smallwares, so this would be plates, glassware that breaks, silverware that ends up in the trash can and needs to be replaced. We have our supplies category, which is our to-go packaging, anything that our printer paper for our kitchen printers, if you have kitchen printers, anything that basically is utilized in the restaurant that either walks out the door or goes in the trash. Postage, if you're mailing things or shipping things regularly for your business. Telephone. We have our credit card fees in here. Depending on what point of sale system you use, you may end up using their processing, or you may be able to go out and get your own credit card processing. We've budgeted for this particular restaurant based on the point of sale system that they're going to be using at 3.5% of their total gross revenue. We also have our TV dues and subscriptions. This could mean televisions for playing sports games. You need to pay a cable provider for that. This could mean a host of other softwares that you're utilizing, things like that. And then we have our repairs and maintenance. And then we have our previous loan. If we have a loan that we need to be paying off, we have any other taxes that are specific to your area. We have repairs and maintenance. Laundry and cleaning. This can be a significant number if you're using linens and tablecloths and you're working with a linen service. If you require landscaping maintenance, it's outside of your CAM charges. If that would go under here. Any professional fees, lawyers, restaurant consultants, accountants, people like that. A marketing budget, any 401k match that you would want to be doing, any charity contributions, any freight that's associated with any of the items you're receiving. There could be special order items. Inventory adjustments are adjustments when your inventory is short or over. We would put that there. We don't generally predict that in a Proforma, however. Any website hosting fees, any kind of ongoing artwork, and then any kind of late fees and charges. And this produces what we call an EBITDA. And basically what EBITDA means is this is your profit based off of your prime cost plus your total operating expenses. And then we subtract that total from your revenue. EBITDA is a profit before interest, taxes, depreciation, and amortization. And then that generates an operating income of about $69,000. Now, if we want to move over to our 10-year prediction, you can see all the same numbers, but these are totaled for the years, year 1, year 2, year 3, year 4. And as we come down here, in the 10-year, we're going to take a little bit better look at our profit after EBITDA. And so our EBITDA for 2025 is listed at $920,000. And then we have our taxes, which is $193,000. This particular location doesn't have a B&O tax. This particular location doesn't have an alcohol tax. And then our total taxes are $193,000, and our year-end cash is $727,000. Then down here, we have several different ways to look at investments. And I think we'll cover that in a different video, but just know that you can put in your investment strategy and how to pay that back inside your Proforma so that you can understand how much remaining operating income you have each year after you've paid off a specific loan. Well, there you have it. We've taken a quick look at a Proforma and how it works and how to potentially think about one. And again, just as a reminder on how we think about creating Proformas is we first estimate our sales by day part, utilizing the amount of seats that we have or the amount of guests that we can have in a particular period of time, and break that out over the course of the week. We then apply a guest check average, and that produces our projected annual sales. We then break our sales into monthly categories and weight those months based off of when we think we're going to be busier in each time of the year. And then we come down here and we predict our salaried labor, and then we predict our hourly labor, both front of the house and kitchen. That can again be done just by plugging in percentage points or utilizing something more robust like a front of the house or kitchen labor predictive model. And then after we do that, we estimate our category net sales, which is when we predict how much of our total sales is going to be allocated to each sales category. And then we predict our cost of goods for each of those sales categories. And then we plug in our increases for our 5-year projection and 10-year projection. So we'll increase our sales, our expenses, our labor, and our rent. And then from there, we may want to predict our medical insurance. We may plug in our taxes. We may also plug in our predicted comps. And we can take a look at our 1 year, which in this case is a 2025 Proforma. And we would go through and add in our operating expenses that we're predicting. From there, we would take our 10-year and start thinking about how we would pay back investments, and also look at our total 10-year Proforma to make sure that this is a business we actually want to open and get into. Thank you again for listening, and I appreciate your time. Thank you.